So far we've talked a lot about the art of making this decision. Here I want to talk a little bit about the the science. So the T stands for testing with scenarios. I think it's important for people when they're thinking about selling their stock or holding their stock to understand what the universe of possible outcomes are. And we can do this statistically, and we can do it pretty easily with a basic tool. So if you know anybody who is a whiz at Excel, they could probably create what's called a Monte Carlo simulation for you. What this is it basically takes the statistical out profile of your company stock or the market as a whole and says, we're going to run thousands of scenarios here and figure out what's the probability of different scenarios over time. And that's what this graph shows you here. So if you look to the right, it's taking thousands of outcomes and it's saying, okay, the dark blue, these are the most likely outcomes in the range. And then there are outliers, of course, over time, but they're much less likely. Okay, so how do we do that for you? Well, I built a model myself that I'm happy to share that shows, hey, the return on your company stock is a variable. The return on a diversified portfolio is. And then the question is, how would you time those sales and move from a concentrated position to a diversified position? What are the possibilities, right? So what I tell clients all the time about this is people like to do forecasts. Forecasts, the old joke about forecasts is they're always wrong. The question is by how much. But when you run a Monte Carlo simulation, you're looking at probabilities, right? Probabilities are always correct, and forecasts are usually wrong. The question is to what degree. So I think it's really important for people to understand what could happen and then make decisions on those probabilities. Now, there are two things here that I think are going through this process are really, really helpful. One is it gives you perspective. This is the bullet at the bottom here. What I think is important is not only to show these Monte Carlos, but to show what can happen with your money over time. I call it the seeing is believing. The power of compounding is often people realize, hey, I don't have to take the amount of risk that I think I do to grow my portfolio to a point where it supports me well, right? It leads people to take less risk, which means there's going to be more certainty in your outcome. And the other thing I see happen a lot is people often think about these things in the binary, right? I either need to sell or I need to hold. What I think most people determine when we do this is that some point in between is more likely. Don't be binary. It's going to be, hey, I'm going to hold some of my stock because I want that potential upside, but I'm not going to let it ride and bet against the volatility that could really decrease the size of my portfolio. So almost always that's the decision that people come to, somewhere in between.